In March 2025, JP Morgan's chief economist said there's a 40% chance the U.S. will face a recession in 2025. Trump's tariffs, a rocky stock market, and headline after headline makes an economic downturn seem inevitable. We should all panic, pull out our money, and start stowing it under our bed, right? Wrong. Now more than ever is a time to make sure that your portfolio is diversified. You have a handle on where your money is and how it's working for you. If you're far away from retirement, an economic downturn can actually be an amazing time for economic opportunity. And some of your best advice may be to just keep on keeping on and ignore a recession where possible. We'll talk through how to take control of your finances and set yourself up for financial success, recession or not. Before we get into that, a quick introduction. I'm Kimmy. I'm 30 years old, living in New York City, working in technology audit consulting, and welcome to On Our Way, a channel where we talk about navigating careers and life through the lens of being women still on our way through it. Having control over your money is power. You could be making $1 million a year, but if you're not in control of where it's going, you'll never feel financially comfortable and confident, even when the economy is doing well. I'm not a financial expert by any means. My drive to create this video isn't because I have some secret finance sauce. It's to give the other non-finance girls the tools to be confident in managing their money. I used to rely on my parents for finance advice, and then my now fiance who works in finance. Over the past half a decade though of digging deeper and thinking critically about where my money was going, I realized this isn't rocket science. I didn't need to rely on my parents, and I don't need to rely on my partner to figure this stuff out and get my money working for me. I'm making this video to share with the girlies what I've learned and what's worked for me, so no one has to rely on their parents, partners, or anyone, frankly, to manage their finances. I promise you, it's not as complicated as you may think. If I can grasp it as a non-finance girl myself, you got this. Ride it out. If you already have investments in stocks or ETFs through a personal brokerage account or retirement accounts, you may be tempted to log into your bank's portal and see the damage. Spoiler alert, it might look like a bloodbath in there with all those red numbers representing your losses. All this is showing you though is your portfolio isn't as valuable as it has been at this moment in time. It's not indicative of your holdings never having value again. If you can, hold your investments and don't run to sell. If there was a sale on your favorite designer shoes, now would not be a time to try to poshmark your used designer shoes, simply because there's too much supply and not enough demand, hence the reason for the sale. You'd hold off until there's more demand for the shoes, aka when there's not a crazy sale going on. Investments are similar. Selling during a downturn locks in a loss. Give your portfolio a chance to go back up. This is not the first economic downturn, and it will not be the last. It always comes back. A recent example of this was COVID in 2020. The stock market tanked, but by August of that year, it was already recovered and since has had some amazing years. If you panic sold in March 2020, you'd be kicking yourself just 6 months later. In March 2020, right when COVID hit, if you invested $10 weekly, by August of 2020, just 6 months later, you would have made roughly $80. If you kept going with that until February of 2025, you would have made approximately $400. If you panic sold, you would have lost out on that upside. Take a deep breath. And remember that this too shall pass. Your investments are a long-term play. Bulk up your rainy day fund. If, like most of us corporate worker bees, you rely on a paycheck to make ends meet, now is a great time to make sure you're stashing some of that away in case, heaven forbid, layoffs happen or you're out of work in some way. I refer to this tactic as smart squirreling, which means making sure that you have a chunk of change stashed away in the event that you do lose your job. Rule of thumb is to have 3 to 6 months saved up. This would mean for 3 to 6 months you could survive off liquid assets, so paying rent, utilities, groceries, and so on. With economic uncertainty, it's nice to have a smidge more cushion if you can. I have about 8 months worth saved completely liquid across checking, traditional savings, and my high yield savings account. This is money that I can access right now. It's not tied up in the market, bonds, or certificate of deposit, so there won't be a penalty for me pulling it out prematurely. Now's a great time to start squirreling away $100 or so a paycheck to a high yield savings account to prepare for the worst. As a reminder, a high yield savings account is basically an in-between of everyday money and long-term lockup. In traditional savings account, you make pennies by keeping your money there. In a high yield savings account, you get monthly interest for keeping your money in there. Right now, most annual interest rates are around 3.75% for high yield savings accounts. Meaning if you put $10,000 in a year, the bank will have paid you about $375. Inflation last year was around 3%. So by only keeping your money in normal savings account or worse, stashed under the bed, your money's actually losing value. You can't make more than a handful of withdrawals a month, so you can't use this as your everyday checking account, but it's a great place to keep the bulk of your savings because it's working for you. That's why it's smart squirreling, because in a time of economic uncertainty, we need all the extra dollars we can find. Debt management. Try not to enter an economic time of uncertainty with existing high interest debt because your confidence to pay it off may be lower than usual. Take a look at your spending and make an actionable plan to pay off any high interest debt you can and not take on more. This is debt with interest rates of above 10 to 15%, so excluding a mortgage or student loans. Let's keep it simple with a credit card. My rule of thumb for paying for something with a credit card is don't buy it unless I can pay it off instantly. Meaning I view a credit card as simply a way to build credit and get points, not a way to buy something that I don't have the money for at that moment. If I can't instantly pay for those $400 pair of shoes, I shouldn't buy them, even if I technically have the credit to do so. Without this view, you can go around thinking that you're way richer than you are. Heaven forbid you get laid off, that rainy day fund will not go as far if you have high interest debt that you're working to pay off. To put it in perspective, the average credit card interest rate or APR in 2024 was around 21.47%. If you have a balance of $2,000 and take 6 months to pay it off, then you will have paid $130 in interest. Make it routine to be paying off that credit card every 2 weeks or at minimum once a month, so you're not in that predicament of having to pay high interest rates because you're living beyond your means. Buy the dip. Now say you're building up that emergency fund, paying off your debt, and have a couple of extra bucks, buy the dip. And I'm not talking about hummus. View this as an opportunity to buy stocks and ETFs at a lower price. Kind of like that shoe sale we referenced earlier. If you saw that your favorite designer was having a sale, you wouldn't run and sound the alarm bells. You'd be excited and nabbing up your favorite flats in multiple colors, running and telling your friends about what an amazing opportunity this is. Future you will thank you for funneling your tax refund into the market rather than going to Nordstrom. A recession is a similar opportunity to invest, and unlike most shoes, the value of your investment over the long term will only increase. Your rich friends and any finance bro is doing this as we speak. I promise you. Now, if you're sold, there's different ways that you can invest in the market. You can buy individual stocks like a stock in Apple, or you can buy ETFs or exchange traded funds, which are basically a basket of stocks. You can buy shares of an ETF that tracks the S&P 500, which is the stock market index that tracks the largest 500 companies. So rather than buying a piece of a particular company, you can buy a share that's made up of a lot of different companies. And this is typically less risky, less volatile than shares of an individual company. One ETF that has been performing particularly well for me is VOO, V-O-O, which tracks the S&P 500. Not only do ETFs have a higher track record, but they're also less risk from a research perspective. So you non-finance girls, I got you. I acknowledge that having the means during a downturn to invest is a privilege, but I do want to remind you though that you can start investing with as little as a couple of dollars. Don't get hung up on needing to have thousands to invest or trying to time it all perfectly. The best time to invest was always yesterday, so even if you have a couple dollars, get started. If you've been investing, continue doing what you're doing. And if you have a couple extra dollars or a tax refund, consider deploying some of that into the market. By getting started or staying the course, you'll be giving compounding interest time to do its thing. Compounding interest means that you earn money on your principal, whatever amount you bought the bond, stock, or ETF for, and on the interest or gains along the way. For example, if you invest $1,000 today in a high yield savings account with 4.5% annual interest, in 10 years, you'll have $1,560. If you invest that $1,000 in the S&P 500 and it returns on average 10% annually, you could have $2,700 in 10 years. And the difference only grows bigger and bigger over time, the longer that money is left in there, since you're earning interest or gains on the principal, plus the interest or gains you're earning along the way. For me, the best way to hold myself accountable and continue to invest despite the economic tone of the day is Auto routing, baby. On a monthly basis, I set up auto transfers from the account that my paycheck is deposited into to my high yield savings and my individual brokerage account where I invest in those ETFs. This auto transfer has been the biggest shift for me over the past couple of years. Before that, at the end of every month, I was routing any leftover into those accounts, but I found myself making a lot of excuses like, shoot, the market's not doing so hot. Should I just squirrel that money under my bed instead? Auto transfers now take that decision making out of it and help me stay the course despite the headlines of the day. The bottom line here is the bottom line of a lot of personal finance videos. Take control of your finances and don't shy away because of some scary headlines. Investing is a long-term play. Recessions all end. If you can keep on keeping on with your investments, savings, and debt management, you'll be that rich friend that can take advantage of the next designer shoe sale. If I can figure this out as a non-finance girl myself, you got this. It's not as complicated as you may think. And obviously, be kind to yourself. Life happens. If you follow your money management rules, even 85% of the time, you'll be in a lot better spot than if you don't have any money management rules at all. Please like and subscribe, as well as leave a comment with your thoughts on money management during a downturn as we all continue on our way through these crazy times.